Futures sink as Trump pressures Powell. 30 minutes until the official start of trading. I'm Katie Greifeld.
And I'm Sonali Basak. Matt Miller is off today, and Bloomberg Open Interest starts right now.
Coming up, the Sell America trade gathers momentum as the White House considers firing Fed Chair Powell. Meanwhile, China fires another warning shot, Beijing telling countries not to cut U.S. trade deals at its expense. And on the corporate front, earnings season ramps up with heavyweights such as Tesla and Alphabet set to report this week. And on that note, let's check in on Tesla because it's under pressure this morning after Dan Ives warned investors that it faces a, quote, code red moment if Elon Musk doesn't pivot his attention away from his government work.
I've got some green on the screen for you pre-market here, Katie. I'm looking at Capital One higher after receiving approval from U.S. regulators to buy Discover in a deal to create the nation's biggest credit card issuer by loan volume. Discover also on a tear.
So some good news there. I have some bad news if you're a bull, and that's that futures are dropping due to concerns that President Trump will fire Federal Reserve Chairman Jerome Powell. That's a move that's seen as a major threat to the credibility of the central bank.
The fact is, the inflation rate is higher, growth is slower, the job market is worse. So we really, I strongly hope that we do not move ourselves into an environment where monetary independence is questioned.
If you think that it's unacceptable for President Trump to be frustrated with the policy history of the Fed, then I think that you got some explaining to do.
Now let's talk about the state of play with Michael McKee. He is Bloomberg's chief international economics and policy correspondent. A lot to really break through here in terms of what the ramifications would be of something like this. But more importantly, how likely is it that he would be able to pursue this?
It isn't clear at this point. It would be a difficult path. There's a couple of things that have to happen. First of all, you look at the Federal Reserve Act, and it says that the members of the Board of Governors can only be fired for cause, unless sooner removed for cause by the president, it says. What does cause mean? Well, it's not defined in the Federal Reserve Act. Courts have historically interpreted that phrase to mean misconduct, incompetence, incapacity, but it's never been litigated in terms of the Fed. The Supreme Court is now considering whether to take up cases on Trump's firings of members of the boards at the National Labor Relations Board and the Merit Systems Protection Board. We don't know when they will make a decision on what they're going to do, but if the court were to rule that they could be fired, it might be easier then for the president to argue the Fed's chair could be fired, although there are arguments in favor of the Fed being a different kind of institution. So then where does that leave us? Well, Jay Powell's term as Fed chair ends in May of 2026. So the talk of them interviewing people this fall is what you would expect to prepare in advance. As a Fed governor, though, he could stay on until January of 2028. Michael Barr is doing that as the former vice chair for supervision. As FOMC chair, the policymaking group, their chair is elected every year. It's traditionally always been the chairman of the Board of Governors, but it could be somebody else. So if Trump were to demote Powell as chairman, but he's still on the board, he could still be chairing that group, and the president would not be happy.
So it sounds like there's potentially a path here to removing Powell, at least to demoting him, and it's potentially very messy. I want to talk about how the bond market might receive this. There was a really interesting note out from Neil Dutta of Renaissance Macro this morning saying that getting rid of Powell in such a dramatic fashion would upset the bond market, and as such, he doesn't think that Trump will go there. We know that the bond market has sort of acted as this disciplining mechanism so far in the Trump presidency.
And likely to continue that. If he were to move on Jay Powell, you could only imagine what the reaction in the markets would be, because people would feel like he's trying to put in somebody who's going to be extremely dovish and do his bidding. And when that happens, historically, we've seen central banks get into a lot of trouble. The last time it happened in the U.S., Richard Nixon put in Arthur Burns, his economic advisor, as chair of the Fed, and then told Burns to let the economy run hot for the '72 election. And we ended up with the great inflation. So the Fed is going to be very nervous about something like that, and the markets are probably going to react very badly. As someone said, if you thought the tariff reaction was bad, you're going to love the firing Powell reaction.
Yeah, a painful history lesson there when it comes to the Nixon-Burns experience. That is Bloomberg's Michael McKee. Now let's turn to the trade war, because China says it will retaliate if countries make deals with the U.S. that could harm Beijing's interests. This comes as global economic and finance leaders gather in Washington for IMF and World Bank meetings this week. Bloomberg's Tyler Kendall is at the White House. So Tyler, it sounds like Beijing is saying, okay, you can cut deals with the U.S., just make sure you keep us out of it.
Right, exactly, Katie. China's Ministry of Commerce now saying that they will take countermeasures against any countries that strike a deal with the U.S. that they see as harming Beijing's interests. Bloomberg News reported last week that this White House was getting ready to ask countries to curb their own trade with China amid the tariff trade talks. And people familiar tell Bloomberg that could include imposing so-called secondary tariffs on countries that have close ties with China, as well as asking countries outright not to absorb excess Chinese goods that are likely to flow into the market. Not to mention that yesterday on Truth Social, President Trump said that he would like to see cutting down on the transshipment of goods. This White House has often alleged that China is using third-party countries to circumvent tariffs in their own way. So those are potentially some themes that we could be following here as Beijing ups its rhetoric against the U.S. And we should note that this could really pose some problems for Southeast Asian countries like Vietnam and Cambodia, both of which Xi Jinping actually visited directly last week on his own tour of Southeast Asia to try to shore up support. Shana and Katie, we know that this White House is really trying to prioritize those countries that are geographically close to China. And we could actually get some headlines today. Vice President J.D. Vance is in India. We know that trade talks are resuming. And this is, of course, one of those countries that this White House has often said that they could shore up ties with in order to counter China.
Certainly the relationship with India, certainly on watch, but also with Japan. And there were some signs of optimism from the Treasury Secretary in particular, and Signum Global now keeping an eye out for that possible finance minister and Besant meeting this week. Are there expected to be clear deals, if not more optimism, taken out of those meetings?
Right. Well, President Trump, we should also say, yes, last week was directly involved in these talks. And we even saw some sharp words from Japan's prime minister saying that they are not going to give away all of the concessions, but that they are willing to make some deals here. And as you mentioned, we are expecting these trade talks to pick up later this month. So, you know, before May really begins. And there's a couple of threads that we are watching. Japan has already pledged that it will boost U.S. LNG imports. But then we know that this White House would also like to see commitments when it comes to boosting agricultural imports into the country, as well as lessening the restrictions on U.S. auto imports into Japan. This is going to be one of those really important things that we watch when it comes to those non-tariff barriers. President Trump has often criticized Japan for what he alleges are stricter exemptions to get U.S. cars into Japan. And we have to keep in mind that they are, of course, negotiating the so-called reciprocal tariff plan, but sector-specific tariffs, particularly when it comes to autos, could hit Japan particularly hard, considering that it's its most lucrative export market.
Tyler Kendall reporting from the White House for Bloomberg News. We're going to now turn to earnings because Tesla reports tomorrow after the close, and shares are down pre-market after one of the company's biggest bulls sent a stark warning to investors. Wedbush analyst Dan Ives said this is a code red moment for Tesla, as Katie had mentioned earlier, and Elon Musk now needs to pivot his focus from the Department of Government Efficiency to avoid lasting brand damage. Caroline Hyde from Bloomberg Technology joins us here at the desk. This is a stock that has sorely suffered. It's down more than 40% this year, and even more pre-market now ahead of those earnings. How does Musk turn the ship around for Tesla while still working for Doge?
By not working for Doge seems to be Wedbush's argument here. And this is not new coming from Dan Ives. He's come on our show, your show, many a show, saying he needs to come back and lead this company. He needs to return his attention to be the CEO of Tesla. Musk and Tesla, the two brands of those people and companies are intertwined. And the moment the allocation of Musk towards helping the administration, focusing on Doge, is leading to brand damage, it's leading to that more than 40% slip in the share price since the administration came to bear cuts come January the 19th. And he says, just go out to car buyers, whether you be in Europe or the US, you can tell that is lasting brand damage, but he needs to come back and just distance himself from what's happening over in the administration right now. We have the earnings coming out on Tuesday, and we are likely to see just about 1% growth in revenue. We're seeing really a dulling in the overall growth momentum. Where is the vision for robo-taxis? Where is the vision for humanoid robots? Where is the vision for Tesla coming back and picking up sales at this moment?
Yeah, I think we got a preview of what we're going to get in terms of numbers tomorrow. You remember the first quarter delivery numbers were pretty awful, but it's the concept of the damage already being done that really interests me. You mentioned Dan Ives, and he wrote that Tesla faces potentially 15 to 20% permanent demand destruction for future Tesla buyers. So even if he does step back from Doge, it's hard to put that genie back in the bottle.
What's interesting, though, is Dan Ives isn't saying sell the stock. He's still overweight the stock. He's still saying that the price target is 315, much higher than it currently is at. So he does think this is rectifiable to a certain extent, that he can come back and undo some of that lasting damage. But if he stays away from the business, he starts to still see the overall long-term brand damage, where they alienate some of the more left-of-center progressive purchasers of EVs and instead aren't able to mobilize other new buyers coming to the fore. This is going to be an undermining tactic. We do see 13 sells on the stock, 33 buys at the moment.
It's a big week for big tech.
It
and
is.
In addition to Tesla, let's take a look at Alphabet, where the shares are down more than 20%. We're looking for earnings. We're looking to see how the Google and DOJ battle over the monopoly question in the United States will take shape. How do you think about how they're going to face investors this week with that many questions to answer?
Sundar Pichai has a busy week because he's, of course, starting the remedy trial today when it comes to monopolization of search. Now, last week it was all about monopolization of ad tech, and we're yet to see what the remedy trial would bring to that. This is a totally different case, all about the monopolization of search, and this is a remedy hearing. Ultimately, what does Google, what does Alphabet, the parent company, need to do to prove to the judge back in August, who had 286 pages of why he felt that Alphabet and Google is ultimately a monopoly? How do they prove and do remedies to fight that back? Is it by selling Chrome, which is what the judge in particular has been talking about? Is it by allowing customers to access to the data and payments? Look, a lot of people out there actually don't want to see an unwind of Chrome, particularly if you're a user, for example, who uses Chrome as your search, but also has an Android phone. They're deeply integrated. But you know, Apple gets $26 billion from Alphabet per year because they're able to basically pay for the privilege of having Google as the bespoke browser in an Apple phone. But Mozilla, other companies also get payments from Google. So it's going to be really interesting to see how that trial progresses and what we hear from Eddie Q from Apple, what you hear from Sundar Pichai. But then the numbers coming on Thursday. We're likely to see revenue up 12%. You're still seeing a growth in terms of earnings per share. This is a company that manages to outperform. This is likely to go all the way up to the Supreme Court. They're going to fight this. They're going to continue to appeal it. And remember, the EU is also looking at whether or not Google has a monopoly in search and also in ad tech too.
All right, a busy week for big tech, a busy week for Caroline Hyde. You can catch her on Bloomberg Technology at 11 a.m. But let's take a check on where futures are trading ahead of the bell. As you can see, we're down about 1% when it comes to the S&P 500. Really, everything U.S. is down right now because you have bonds selling off, bond yields higher by about 6 basis points on your 10-year Treasury yield. You're seeing no love for the dollar with the Bloomberg Dollar Index down about 0.8%. Where you are seeing a haven bid is in gold, hitting another record high this morning, currently higher by about 2.8%. Now coming up, also on the earnings front, Netflix last week posting record profits as the streaming giant seemingly resilient against the current climate. We'll take a look next. This is Open Interest. Welcome back to Open Interest. Let's take a look at Netflix. The stock is higher pre-market after the streaming giant posted a beat and raised quarter last week. So let's discuss now with Bloomberg's Ryan Vlastelica. So numbers aside, Ryan, what really caught my eye is the fact that you had the co-CEO coming out and saying, really, we've seen no impact so far from all of this tariff talk.
Yeah, good morning. Thank you for having me. I would say that was largely expected. I don't think this kind of entertainment, subscription-based company is likely to see the same kind of tariff impact as, discretionary stocks or hardware in tech. So not necessarily surprised there, but certainly a very positive signal that this company, as many people have been saying, is very well positioned for this kind of backdrop. And even if there is a kind of a broader economic weakness, it is also seen as pretty resilient against some kind of a recession environment.
Well, that was going to be my question, Ryan. How immune could it be? You're seeing consumer sentiment start to turn in a pretty significant way, yet Netflix seemingly shake it off. If we hit a recession or even a severe recession, do they continue to shake it off?
That is sort of the expectation on Wall Street. I think the argument is really that, a Netflix subscription isn't all that expensive. You get a ton of content. And if you are, pulling back elsewhere, this is maybe one of the things you pull back last on just because, you're probably going to want some kind of entertainment, even if you are otherwise, tightening your belt. Netflix is a pretty reasonable place for people to be doing that. So in the past, we've seen in other recessions, including 2012 and COVID, although there was a lot of complicating factors there, people don't pull back on their Netflix subscriptions just because they see it as giving them a pretty good value.
Well, speaking of subscriptions, this was the first report where Netflix didn't disclose how many customers they added or lost. Did we see analysts try to tease them out of that on the earnings call?
Yeah, I think there is still a lot of interest surrounding this, but I think just overall the broader trends in terms of profitability, cash flow, so on and so forth, I think those are all enough that people are kind of willing to let this one data point go. Obviously, they would prefer it continue to be disclosed, but overall, I think people are pretty positive on the overall trends here. So losing this one thing isn't enough for people to really start to become cautious on it. It's not like they are doing this from a position of weakness or at a time when trends are really weakening.
Bloomberg's Ryan Vlastelica. One more question I had, and thank you for joining us here on the Netflix news, of course. Katie, one thing I've been looking at is the ripple effects, not only for Netflix, even if they're immune on a subscriber basis potentially, one issue you might have here is ad spending. And that's where I want to see if there's really any issue for the other big tech players. Also looking, our producer Will Shaker pointed this out in the morning meeting today, you have some optimism around other companies that look a little more like Netflix, like Spotify as well.
Specifically to Netflix, I mean, I hear your point on ad spending, though they did say that they're ready to roll out lower price subscription plans if we do see some economic pain. We're talking about their resilience, their business resilience to these tariffs, but their stock has also been quite resilient as well, Chanel. You take a look at the year-to-date performance of Netflix, it's higher by 9% on a total return basis as the rest of the market and as the rest of the tech sector has really gotten wiped out. So that certainly tells you something.
Who was it? Remember the FANG stocks?
Yeah, I think that was Bailey.
Right. Anyways, now to high interest. We're going to take a look at what's making headlines around the world. Ken Griffin and Paul Singer struck a cautious tone at a Goldman hedge fund conference in Abu Dhabi. The meeting comes against the backdrop of tariff-driven turmoil that's roiled markets. The Middle East has become increasingly attractive with Abu Dhabi's emergence as a serious global financial center. And Pete Hegseth's former spokesman says the Pentagon is overwhelmed by staff drama and a turnover, calling it a full-blown meltdown that could cost the defense secretary his job. Hegseth is already under scrutiny for sharing confidential information about Yemen strikes in a Signal chat group. The New York Times is now reporting on a second Signal chat in which Hegseth is said to have started sensitive plans with a group that included his wife and brother. And Pope Francis has died at the age of 88, just one day after Easter Sunday. He was the first pope from Latin America and the first born outside of Europe in over a millennia. He was hospitalized in Rome in mid-February with bronchitis, which progressed to pneumonia in both lungs. The New York Stock Exchange and the NASDAQ are holding a moment of silence in honor of the late Pope Francis.
Well, it's earnings season, and the S&P 500's earnings revisions breath is approaching downside extremes as analysts slash their expectations. Morgan Stanley's Mike Wilson says that companies face more uncertainties than the early days of the pandemic, and that the S&P 500 should stay in the 5,000 to 5,500 range until recession risks are determined through hard data. Let's keep the conversation going with RBC Capital Markets Head of Derivative Strategy, Amy Wu Silverman. Amy, great to see you in person.
Great to see you.
So as we head into the heart of earnings season, you're seeing analysts obviously downgrade their expectations. How are investors positioning for what's shaping up to be a pretty rocky road?
Yeah, certainly. And when you kind of think about the earnings implied moves coming into the season, they were extraordinarily high. Not too surprising compared to the last 8 quarters. We obviously just had this momentous shift in correlation too that are keeping things bid. Things have come in a little bit. This week's felt a little spa-like relative to post-Liberation Day. But there are some exceptions. Tesla still remains extremely bearish sentiment, really elevated skews, even though everything else has kind of come in with the market.
Is there anything that executives are saying that is cooling the nerves? It's really so much about the outlook at this point, given the first quarter didn't account for a lot of the tariff-related measures.
Yeah, I think investors are hanging on every word, and now you have a few companies giving these multi-scenario guidance.
Right.
And it's really interesting. It almost makes the earnings themselves almost like a binary option if you think about it. And then there's obviously the option sentiment on top of that. But in general, the feedback I've received is investors would rather have that than companies not be able to say anything at all.
Well, I'm glad you brought that up because we saw that from United. We also, in a way, saw it from the Bank of Canada as well. We have about 30 seconds left with you in this block, but you think about some of the other names taking the stage. Would you expect to see more of that sort of roadmap scenario, blueprint?
I certainly would. It makes a lot of sense. It's very reasonable. And if you think about it, if the companies from a stock perspective are getting rewarded for that post-earnings, I don't see why other management teams wouldn't consider it as well.
All right, we'll find out soon enough. Amy Wu Silverman, you are sticking with us through the opening bells. And here's the setup as we're heading in. The S&P 500 down pre-market. We're hanging out about 1.1% lower. We've been there for a while now. And it's this sell America theme that you're seeing across asset classes right now, from the 10-year Treasury to the Bloomberg Dollar Index, all lower on the day. That means yields higher and people really seeking safety in gold, in hard assets. Gold at a record high of about 2.7%. We'll bring you all the action on this Monday at the opening bell next. This is Open Interest. All right, we are moments away from the start of trading. Welcome back to Bloomberg Open Interest. I'm Katie Greifeld. Of course, we're coming off of weekly losses, down about 1.5% last week on the S&P 500. And then there's a lot of nervousness in this market. You think about the uncertainty over trade, what's going to happen with tariffs. You think about the uncertainty over Jerome Powell's future as the head of the Federal Reserve. And you think about the uncertainty over the corporate earnings picture, of course, with analysts revising downwards their earnings expectations. There's a lot of volatility in this market, but the bells are ringing nonetheless. You can see the clapping over at the New York Stock Exchange, over at the NASDAQ. There's not too much to cheer if we take a look at the early trading, though, at the start of this fresh new week. The S&P 500 hopefully will show it. It's down about 1% right now in the cash trading. And then you take a look at what is actually dragging these indexes down. It's Tesla, front and center, under pressure, of course, after analyst Dan Ives warned investors that it faces a, quote, code red moment if Elon Musk doesn't pivot his attention away from Doge, down about almost 5% right now, Sonali, down almost 40% or so since the inauguration.
And Katie, I'm also taking a look at Capital One higher after receiving approval from U.S. regulators to buy Discover in a deal to create the nation's biggest credit card issuer by loan volume. And we are back now with RBC Capital Markets Head of Derivative Strategy, Amy Wu Silverman. It's interesting, a little bit of green under what is really a bigger sea of red today. A lot of uncertainty, as we've been discussing. We've been talking about earnings season, but what about the White House? Ultimately, what they say is what's driving the picture. We've been talking about bond yields. We've been talking a lot about the uncertainty around Trump's relationship to Powell and whether he actually is able to fire the Fed chair. What does that mean for broader risk assets?
Look, I'm going to tell my first bad vol joke of the day, but everyone's heard of theta, but there's another Greek we should think about, which is tweta, which is just the idea that at any point in time you get this idiosyncratic risk from the White House. It brings correlations up no matter where we are in earnings season, ex-earnings season. And the issue is, all this to me funnels to the risk-free rate and to the volatility regime we're in. So, we were talking at break about just the resting heart rate of the VIX being higher. That's not healthy for the patient. A 30 handle on the VIX that we just get used to doesn't mean that it is good that we feel these swings kind of viscerally intraday.
Yeah, absolutely. It feels like you could also call it the neutral rate of the VIX wherever it stands right now. It certainly seems higher than it was before. I do want to ask if you're seeing any of that getting priced in. You think about people grabbing extreme tail risk hedges, hedging for a potential black swan. Are you seeing any of that in your world?
We absolutely are, and we kind of track it through multiple. You can look at the volatility of the VIX. You can look at SDEX or TDX, which measures the 1 in 3 standard deviation drawdowns that cost in the market. They've all climbed to year-to-date highs. What we really want to know is how does this look on a historical basis when you bake in COVID, when you bake in the global financial crisis, they still look reasonable. If you start to see those tick up, that's a big question mark, because we already know that a lot of these kind of safe havens, Mag 7, for instance, or the US dollar, are no longer these safe havens. And so when you really start see these tick up as well, that's very alarming.
And you think about these hedging products, particularly at a time when you think about how much the equity market has drawn down. It has been significant, but we haven't hit those alarming levels. A lot of people talking about that very scary level of the 200-week moving average, which you haven't really seen unless we've hit a crisis. Now, when you look at the market today, are you concerned that investors aren't pricing in a recession or a deeper recession?
Yes, and I'll tell you what I think is also related to that. So Lori Calrissian, our chief equity strategist, she likes to call these the tiers of fear, right? So we're kind of floating in that tier 2 right now. The issue is nobody grinds down from a tier 2 of fear to a tier 3 of fear. It's always a gap down. And you kind of saw that post-Liberation Day when people kind of have to acclimate to a new reality. It always happens in this big gap down. So volatility gets repriced very quickly. So the concern's not only that people start to bake that in more than it is already baked in, it's the velocity at which it happens is not going to be a smooth ride.
I'm also curious how you're taking a look at cross asset volatility right now, because it seems like everything was moving in lockstep after you got the Liberation Day announcement, then you got the 90-day pause. You saw a sigh of relief across investment grade credit, across treasury yields, across stocks right now. But do you think that that is going to continue? Do you think that this will be a concerted move up and down when it comes to these different asset classes? Are we going to see them move out of lockstep at some point?
So if you kind of take Liberation Day as kind of the day one, right, it was actually interesting because there was a delayed reaction. Equity vol reacted first at day 2, and then day 3 was basically credit than rates. So I have to give our market a little bit of credit. We were a little bit earlier on this. And still, if you look at, say, MOVE versus VIX right now, it's still VIX that's kind of carrying the signal, I think, because especially during earnings season, you get that idiosyncratic information from the management teams first. If we start to see more triggers from both the credit side and the rate side, that would also make me nervous because typically that's more tier 3 risk, not tier 2 risk.
Speaking of diversification in any form or fashion, I want to pull up actually what you're seeing in the S&P 500 right now. Because if you look at all the sectors, you're not seeing a single one in the green. Now, for much of the world, it is a holiday, but at that same rate, you are not seeing a lot of love in even sectors that have traditionally been havens. And I'm wondering whether you see some of those traditional safe havens no longer working as safe havens at some point this year.
Yeah, it's been interesting because obviously gold has been where folks have kind of flocked to safety. And it becomes almost an existential question, Sonali, because you think about the risk-free rate, right? And that is baked into everything when you think about portfolio construction. So again, if that resting heart rate is higher, if we're even questioning that underlying sort of treasuries or Mag 7, which there was a time when Mag 7 was your flight to safety, there aren't that many places to go. And the issue is there there is a crowding effect when all people can think about is either gold or perhaps using kind of S&P options as hedges. You're going to see far more activity. Those tails will start to pick up.
Yeah, it's really interesting. I'm glad you used the word existential because that's what it feels like. You think about how bonds have performed. You think about how the dollar has performed. You certainly haven't found any safety there. I am wondering who is the marginal buyer in this market, because I watch the ETF flows pretty closely. You see a big bid coming in through those index tracking products in ETF land, and a lot of people say that really retail is driving the ship here. But I'm curious whether you're seeing any other sort of buying the dip, catching the knife action going on in other classes of buyers.
No.
There you go.
And it's interesting because especially even within retail, you have kind of retail, maybe your Reddit, GameStop crew, but then you have sort of high net worth retail, and even that cohort is drawing back. The question to me is if you lose that incremental other pocket of retail that's been relatively resilient, who's been trained to buy the dip, where is the incremental buyer? But, there's been 5 years of folks being trained to buy that dip, so I wouldn't count it out yet, and I'd be watching those call wings in the past to see if anyone is stepping in the options market.
A good reminder, too, that retail is a broad church. It's not just your message board traders. It's also mom and pop and some of those high net worth folks as well. Amy Wu Silverman of RBC. Meanwhile, let's take a look under this hood. We're about 7-8 minutes into the session. We're going to do that with Bloomberg's Isabel Lee. Isabel, what are you watching?
We're looking at TSMC. It's edging lower by 1.3%. So that's after the company's Arizona subsidiary posted a loss. The company also listed the challenges of ensuring export control compliance by its customers. So this comes months after the company's AI silicon was found to have flowed to Huawei via intermediaries. So again, this highlights the U.S.-China trade war. But overall, the world's largest contract chip maker kept a bullish outlook for 2025. And up next, we're looking at some green. We have Netflix edging higher by around 2%. So the streaming giant reported record profit to start the year. They really have allayed concerns of any slowdown that the economic uncertainty may bring. So first quarter earnings rose 25%. That beats estimates. Sales also came in line with expectations. So investors have come to see Netflix as a safe play. That comes amid the movie and the TV challenges the industry is facing. And of course, even amid all this uncertainty. I mean, with a global audience of more than 700 million viewers, they're probably in a good spot. And last is MicroStrategy. It's edging higher by 2.3%. We have CTBC initiating the coverage of Michael Saylor's firm, and they recommended a buy. So this stock is either a love it or hate it kind of stock, and they're really aggressively buying Bitcoin. Just last week, they bought, again, $6,000 Bitcoin, worth $36.4 billion.
Isabel, we thank you so much for keeping an eye on things. That is Bloomberg's Isabel Lee. Now coming up, more volatility for Hertz after getting a boost from Pershing Square's new stake in the company. More on the auto sector next. This is Bloomberg Open Interest.
Welcome back to Open Interest. You can see that Sell America trade gaining steam right now. The S&P 500 down about 1.3%. Losses accelerating after markets opening. You can see that also that sell-off picking up steam in the bond market with the 10-year Treasury yield higher by about 5 basis points right now. We were above 440 a little bit earlier today, and the dollar also getting caught up in the sell-off, down about 0.8%. Meanwhile, it's time now for our top calls. Some of the analyst action in focus this morning. And first up, Spotify getting raised to a buy over at Wolfe Research. The analyst says it has many paths to improving monetization and notes that the industry is undervalued. Next up, Salesforce getting downgraded to a sell over at D.A. Davidson. The analyst says that this company is neglecting its core business to pursue a premature AI opportunity. Shares down about 2.7%. And finally, Norwegian Cruise Lines getting upgraded to a buy over at CFRA. The analyst cites strong demand and says that cruise efficiencies offset macroeconomic headwinds. Sonali.
Hertz remains volatile after Bill Ackman's Pershing Square amassed a nearly 20% stake in the company, betting that tariffs will boost used car prices. Bloomberg's Detroit bureau chief David Welch joins us to discuss. Now, there was the news itself, and then there's a couple days, and then there was Bill Ackman's missive as to why he invested in Hertz, his long-term future for it, and that potential partnership that they can maybe ink one day without a whole lot of details with Uber. When you looked at his release about why he invested, what did you make of it?
First thing I thought is, look, he sees a company that's not performing well right now, has all kinds of problems, and is very, very cheap. The stock, before he got in, was trading, I think, as low as $3.30 a share. The bonds are also cheap, too. I mean, just everything about Hertz is trading like it's headed toward bankruptcy. So if there's any kind of improvement here, then his bet will pay off. He's his own catalyst, clearly, because once he was in the stock and that was announced, others started buying in. One can imagine that as Hertz maybe refinances some of its debt or restructures its balance sheet, and if they do see some improvement through used car pricing, for example, then there's nothing in Ackman's view but upside here, because the company is not really, I think, in danger of running out of cash at the moment, but it does have a lot of work to do. And I think he sees nothing but upside given where the company is now. It's basically a buy low opportunity for him.
A buy low opportunity. I am curious what the reception from management has been like. Obviously, Bill Ackman taking a nearly 20% in your company could be perceived as bad news by some, but what are we actually hearing from Hertz executives?
So CEO Gil West put out a memo on Friday to the staff basically saying, look, Bill Ackman's interested because he's recognizing our work and the potential that the company has going forward. So Hertz is pretty happy with this. They see it as an endorsement for the kind of operational changes they're trying to make and the turnaround effort that they're trying to pull off.
David, when you think about also this week what we might see from Tesla in particular, how are you thinking about how the entire auto industry is digesting the news of tariffs, particularly given Tesla's a bit of a unique story here with Musk's closeness to the president?
Yeah, look, all the car companies are still wrestling with what's going to happen with tariffs. There was talk from the Trump administration, from Trump himself actually, that we would get relief on the parts tariffs probably Canada and Mexico, which would be great for the Detroit Three, but would really help everybody. But we haven't seen official details, and we haven't seen all of that put in place yet. So they're all trying to wrestle with this. Tesla is actually least afflicted by this because they get, I think, only 15% of their parts from outside the U.S. It still affects them, just not to the degree that it does the Detroit Three and the foreign companies that are importing vehicles into the U.S. market. But as we've seen some analysts say, downgrading the stock, his proximity to the president has caused a political backlash among some buyers. And I've seen research that most EV buyers are, let's say, left of center and further leftward. So if they don't like Trump's proximity to the president, they don't like his if they don't like, Musk's politics, then you've seen some people demur from buying the cars. You've seen some more vehicles show up in the used market. So some buyers or owners are selling them. So investors are worried about that impact, and they also want to see Musk kind of give up the Doge job and go back to running Tesla full time, because sales have been down. They want updates on the self-driving vehicle and some of the AI things that Elon has talked about. They just sort of feel like they want the guy who founded and built the company back at the wheel.
All right, David Welch, great to speak with you ahead of Tesla's big day, of course. A lot of key man risk in that stock when it comes to Elon Musk. A lot of investors want him back at the helm. Meanwhile, we do want to pivot here and take a look at these markets. The S&P 500 hitting a session low, down about 1.4%. Here's a potential reason why. You have President Donald Trump posting on Truth Social that preemptive cuts in interest rates are being called for by many within the White House, that is. You also have him posting that Powell has always been too late, except when it came to the election period, when he lowered in order to help sleepy Joe Biden, later Kamala, get elected. How did that work out? These are the president's words again. So really ratcheting up pressure on Jerome Powell.
Ratcheting up pressure and also kind of shifting blame of any potential slowing of the economy to these high interest rates. He said that there could be a slowing of the economy, and Lester, now he's got a new nickname for him, Mr. Too Late. A major loser, he says, lowers interest rates now. So, of course, watching closely the dynamic between the two as he considers ways to fire the Fed chief.
I like how you phrase that, shifting blame, because that's what it feels like. He also offered some rationale for perhaps why the Federal Reserve would want to cut rates. There's a lot of questions about inflation, but the president posts that energy costs are way down. You have food prices, including Biden's egg disaster, his words, substantially lower, and most other things trending down. There is virtually no inflation. So that debate developing in real time. We'll continue to keep up with that. And coming up, we'll also talk about the $35 billion deal between Capital One and Discover getting the green light from regulators. We'll take a closer look next. This is Open Interest. Welcome back to Open Interest. A check on stocks right now with the S&P 500 near session lows, down about 1.4%. You can see the pain is being led by big tech once again, with the Nasdaq 100 down about 1.6%. Some volatility coming back into this market as measured by the VIX. Let's take a look at the individual stock level. To my left here, Nvidia, Apple, Tesla, all lower today. Netflix seeing a little bit of green. Of course, they had a pretty good earnings report last week that is boosting the stock today. And I want to end on some deal news, Shana. You can see that Capital One and Discover finally getting the blessing for their deal. Both stocks higher right now in Monday's trade.
Exactly. Capital One and Discover higher on that expected merger, expected to close in May, very soon. Bloomberg's Paige Smith has been reporting on the deal, joins us here on set. So what next? We finally have a whole lot of clarity from these companies, and it's, one that didn't go without its challenges in the approval process, at least from lawmakers. What do they become, and how do they shake off any concerns about how consumers might be treated under this new regime?
As you said, this is a long time coming. This deal was announced, just to put it in perspective, more than a year ago. It's a massive deal. It was $35 billion, worth $35 billion when it was first announced in February, a year ago from February. And they were just awaiting this final approval from the Fed and the OCC. And there was a little bit of question, frankly, of whether the Justice Department would challenge the deal and sue. And that has been made clear as well. So as of now, it's sort of full steam ahead. And as you said, Sonali, it's a big deal for these two massive payments companies.
Right.
Capital One is a huge consumer lender. Discover is a very well-known brand as well, so it'll be a big deal moving forward.
Well, give us context on what this means for the landscape overall. Like you said, this is a massive deal, $35 billion when it was announced. I would imagine this creates a behemoth. How does this reshape the competitive landscape?
It is. It would create the largest credit card issuer by loan volume in the United States, to put it in perspective. But it also is interesting because it really gives Capital One, theoretically, if all of the synergies and everything goes to plan, a competitive advantage in the sense that Discover is interesting because it's a credit card network. It's sort of like a Visa or a MasterCard. So now that Capital One would have such a network of its own, it essentially could give Capital One the opportunity to save itself a lot of money and create a lot of synergies, but also essentially create this behemoth where it doesn't need to rely on a Visa or MasterCard as heavily.
This comes at a time where you're seeing the CFPB be extremely defanged. Is that fair to say?
Certainly.
And you're covering that very closely. When investors look at this combined company, do they think that part of the investment case is, wait a minute, they're not going to get sued as much by regulators in the future? Credit cards were a huge part of the story when we think about the last couple of years in terms of financial suits.
I would say I think it's still early to tell. I don't have a crystal ball, nor do I think a lot of folks at this moment in time. But I would say that it is definitely fair to say that the CFPB, a large role that agency played has been pulled back under the Trump administration. Where that agency actually shakes out to be in its final form, we'll have to wait and see. There were some priorities that were published last week by the Trump administration that we reported on that gave investors a bit more clarity of where the agency would be focusing on things like veterans issues, for example, less so on credit card companies.
All right, Paige, really appreciate your reporting. Sure, we'll be speaking to you again soon. That is Bloomberg's Paige Smith. Now, let's take a look ahead at what to expect this week. The IMF World Bank spring meetings begin today in Washington, and tomorrow the IMF is set to lower its growth outlook in its new projections. Also, more than 120 companies report earnings this week, including heavyweights, including Tesla, Alphabet, and Boeing. And to round it all out, we'll get PMI, new home sales, and the Fed Beige Book. Sonali, it will certainly be busy.
And coming up in the next hour, Katie, more on Powell under pressure with Banrion, Shana, Sissel, and former Fed economist Claudia Sahm, plus the outlook for IPOs with the CEO of General Catalyst. This is Bloomberg Open Interest.
All right, we are 30 minutes into the trading day on this Monday. Welcome back to Bloomberg Open Interest. I'm Katie Greifeld.
And I'm Sonali Basak. Matt Miller is off today. And coming up, Trump turns up the heat on Powell. Stocks slump as the White House considers firing the Fed chair. And as investors rethink American exceptionalism, we're going to get the view from Vanguard, one of the world's biggest asset managers. Plus, Wall Street deal-making cools thanks to tariff uncertainty. And we're going to speak to the CEO of General Catalyst, venture capitalist, which may be weighing an IPO.
All that and more coming up. Let's get a check on these markets with the S&P 500 at fresh session lows, down about 1.8%, and Sell America in full effect right now. You can see the 10-year Treasury yield higher by 3 basis points. It was even higher earlier in that session, but maybe you're seeing some of that haven bid return, but of course still higher when it comes to 10-year Treasury yields. And the dollar also not catching any sort of bid. The Bloomberg Dollar Index down about 0.8%. One of the big reasons why potentially is that President Trump is calling on Fed Chair Jay Powell to lower interest rates. This coming in a new Truth Social post. Let's discuss with Bloomberg's Tyler Kendall. She joins us at the White House with the latest. And Tyler, it's hard to separate what is jawboning, what is pressuring Jay Powell when it comes to what Donald Trump is posting versus how much it actually shows about how seriously he is considering trying to take action to remove the Fed chair.
Yeah, hey, Katie, there's a lot of big questions here, particularly the legal pathways that this White House could consider when it comes to potentially removing Jerome Powell. President Trump in this recent post saying that there could be a slowing of the economy if Powell does not cut rates. It does appear that he might be trying to shift the blame here as we see global forecasts really downgrade their growth projections for the next year amid these tariff concerns. Bloomberg Economics just revising its own forecast, saying that it is very likely that the Fed will have one 25 basis point cut likely in December. But President Trump would like to see those rate cuts move up as he pins that this is really to go hand in hand with his tariff policy. And the administration has made clear, at least on Friday, NEC Director Kevin Hassett saying that they are looking at potential legal pathways, saying that they are studying the issue. Now, in theory, Jerome Powell is protected from being fired under the Federal Reserve Act of 1913 that protects Fed officials from being fired without cause. But still, there are already starting to be questions here about whether or not that applies to removing him completely or just removing him as the Fed chairman. And this White House already has a few legal fights brewing that could potentially give us some precedent here. We know the administration is trying to overturn one legal precedent known as Humphrey's executor that has to do with a National Labor Relations Board hearing. A recent commissioner there was fired, and they are contesting that on the grounds of political reasons. But still, we'll have to see if that ends up shaking out here and if that could be served as legal precedent. I did speak to one legal expert that said no matter how the courts decide, there's always the opening that we could potentially see a carve out when it comes to decisions related to monetary policy. But one thing is for sure, it does appear that this White House is ratcheting up the pressure on Jerome Powell. Whether or not they choose to act or find an actual legal pathway to do so remains to be seen.
Yeah, that part is very clear. And we had seen the same thing, that shifting of the blame for a slowing economy to these higher interest rates. One person that has been very silent on this particular issue is the Treasury Secretary. In fact, when he spoke to Anne-Marie days before that initial Trump Truth Social post, he seemed to protect the sanctity of the Federal Reserve's independence. Now, what do we know? Because we do know that Bessent and Fed Chair Powell meet routinely. Do we know whether they have discussed what is happening here?
Right, and Bessent telling Anne-Marie that monetary policy is a jewel box that needs to be preserved. He also said that they would start seriously looking at replacements for him come the fall, considering that we know that Powell's term is up in May of 2026. Now, behind the scenes, there is reporting that Bessent has urged President Trump to proceed here with caution, particularly when it comes to impacts for the stability of the markets going forward if there was to be a shakeup at the Fed. We also know that there is starting to be some reporting swirling around that they have already started to put together potentially a short list when it comes to people that could replace him. Bloomberg News had reported last week that one of those short lists circulating included former Fed Governor Kevin Warsh. But there is new reporting over the weekend that even he himself has urged the president to proceed with caution here and not to appoint him until Powell's term is over. So a lot of big questions here about the procedure. We should also just note, of course, that anybody that ends up being chosen does need to be confirmed by the Senate. Of course, Republicans do control the Senate, so it's very likely whichever pick does end up making it through would be confirmed. But we know that Republicans on the Senate Banking Committee in particular in the past have really urged against any political interference when it comes to the Fed.
And here's the problem, Katie. If you dent the credibility of the Fed at this juncture, Kevin Warsh, as much as anybody knows, that would make his job difficult as well if he were to take over.
Absolutely. Questions of credibility, not how you would want to start your potential term. Tyler Kendall reporting from the White House. Great roundup as always. Let's keep this conversation going now with Shana Sissel. She is founder, president, and chief executive officer of Banrion Capital Management. Joining us now, Shana, it's great to have you. And I want to start with this narrative that has emerged, this story that has emerged that Donald Trump pressuring Jerome Powell in public and privately, weighing options on whether it would be possible to remove him as Fed chair. We've seen this nervousness come out in the market. I'm wondering how you, as an investor, feel about this.
So I have a lot of feelings, but I will say that it is a very, very bad precedent to allow political influence in Fed decisions. The Fed is supposed to be independent. We need it to be independent. We do not want a Fed that is influenced by the political leanings of the president, no matter what. The Fed has to be able to act in the best interest of the capital markets. And the Fed is the only one that really has the ability to kind of take a step back and do things independently, who is not influenced by whether or not, their favorability ratings are going up or down. I think it's really important that we really focus on the fact that it would be unprecedented if the president were to remove Chairman Powell. We know they don't get along. That was something that was kind of touched on when the president was reelected. So I think it's a bad precedent. I think the Fed needs to stay independent. I think that is the criteria that makes the Fed effective. Whether or not we agree with their decisions is a different story. But I do think that the independence of the Fed is paramount.
Shana, good to see you. Sonali Basak here. You think about how much more uncertainty this adds to a pot that has already been boiling over with uncertainty, whether it comes to tariffs or the slowing of the economy or just the general volatility you're seeing in markets right now. When you talk to clients, how willing are they to be investing at this point in time, or are they running for cover?
Well, I think I'm going to answer that question two ways. The first is to say that I think removing a Fed chairman at a time that markets are volatile and uncertain is a major, major, major mistake. But to answer your main question, which is how am I talking to clients, remember, Banrion is a firm that focuses on alternative investments. Our alternative investments, particularly the ETFs in the space, we have an ETF model marketplace, are doing exceptionally well. So the conversations we're having is about helping advisors talk to their end clients about adding alternatives as a diversifier. We've seen in the markets this year, and we saw it in 2022, that fixed income and equity are moving in tandem. And the correlations between the two have been high, which is not something that you think about when you build a 60-40 portfolio. So having an allocation 20%-ish to alternatives can be very, very important to reduce risk in portfolios and kind of dampen volatility. And we are seeing that with a lot of our partners. ETFs in particular, one of that kind of stands out above all the rest is BTAL, right, which I've talked about on the show before. That product is doing quite well, but there are several others, and they're all outperforming the market. So it really does make the case for alternatives, which is where we stand.
Right, yeah, diversification back in vogue in a big way. I do want to talk about where you might start to see some opportunities in public equities right now. You think about AI in particular, NVIDIA, those sorts of names really getting taken out to the woodshed in the last couple of weeks. When does that turn into an opportunity?
I think it already is an opportunity. I've said this numerous times on other Bloomberg programs, but I think we often forget that most of the time when you think about where we get outsized returns in portfolios, it's during these kind of markets. It's not anybody can make money when the market's going straight up. It's actually at times when the markets are volatile, when they're turning downward, when it is so difficult to make that decision to step in and buy, that we make our best returns. If I think about the last time I made excellent returns for my clients in the equity markets, it was during the financial crisis. It was stepping in and buying Apple. It was stepping in and buying Goldman Sachs. It was that kind of thing. I think now is the exact same thing. We look at some of these names and we look at the longer trends, short-term headwinds, but long-term tailwinds. And so NVIDIA, Vertiv, these are the names that I'm taking a look at. Marvell, all of the AI names, I think the long-term trends for AI are persistent. And so I am looking at these options. I'm not trying to pick a bottom. I'm just looking at NVIDIA is trading at one of the most attractive valuations it's ever traded in the history of the stock. So, you know, these are the things that I'm looking for. And again, I'm not trying to pick the bottom, but I am looking to step in when it seems warranted based on valuation.
Bravery in the face of a storm. Shana Sissel of Banrion Capital Management, we thank you so very much for joining us today. And we're going to get a look at the stocks moving under the hood this hour. For that, we bring in Bloomberg's Alex Semenova.
Hey guys, we have to start with Tesla. The troubles seem never ending for the company. Its biggest bull, Dan Ives, says that it's in for a code red moment ahead of earnings on Tuesday. The analyst believes that Musk's involvement with the government has caused a brand damage for the company. He estimates it could result in 15 to 20% of permanent demand destruction for future buyers. Ives is urging Musk to step back from Doge and get back to being the CEO of Tesla. The stock is down about 40% this year on declining sales, competition, and worries about Musk being distracted. 2 weeks ago, you guys remember that Ives slashed his price target for Tesla stock by 43%. He's warning that the company is facing a brand crisis. Shares are down about 7% right now. And then in financial services, we also have Capital One receiving approval from U.S. regulators to buy Discover Financial. A little bit of a merger Monday here. The deal creates the nation's biggest credit card issuer by loan volume, and the transaction was valued at $35 billion when it was announced. The deal is expected to close on May 18th. Quite the positive reaction from analysts. KBW says that this sets up for significant value creation for shareholders. TD Cowen says that this is a positive for future deals. Capital One and Discover both up in the sell-off. And finally, Netflix was a bright spot in a high-stakes earnings season. The streaming giant reported record profit to start the year. This alleviated concerns of a slowdown for the company amid economic uncertainty. Wall Street basically calling the stock recession-proof. Piper Sandler said that it is a defensive name, and Morgan Stanley said that it has a predictable business model. Shares are also higher today.
All right, Alex, great roundup. As always, that is Bloomberg's Alex Semenova. Now, coming up, a tough time for IPOs. We'll next speak with the CEO of General Catalyst about going public in a volatile market. That's next in our Wall Street Beat. This is Open Interest.
And it's time now for the Wall Street Beat. With volatility remaining high, private equity and venture capitalists are left with some tough decisions around waiting to go public or lower valuations, accepting exactly where they are right now. But we have the perfect person to talk to about all of it. General Catalyst is one of the larger venture capitalists behind some of the firms in the IPO pipeline right now. Joining us right now is CEO and Managing Director Hemant Taneja. I mean, there are so many companies that you are so close to right now that are right about to go over that finish line, and then you see the VIX at 30. And so how do you manage that from where you sit?
Yeah, first of all, thanks for having me. Look, I think it's a tricky time because if you're a CEO about to go public, you don't want to be sitting in the public market trying to develop trust with the market with all this volatility, that has nothing to do with you. So I think the general advice is keep running with the rigor of a public company, but let's deal with actually the act of going public when the markets are a little more stable.
So what about yourselves? Recently, it was reported that General Catalyst is in the early stages of considering an IPO. What's that time horizon look like?
So that was just a complete rumor. IPO is not in our cards. We have transitioned to go from traditionally thinking of ourselves as a venture capital firm to a global investment and transformation company. So we run like a business, but we are not thinking about an IPO.
All right, well, keep in touch if you change your mind. You know who to call, and she's sitting to my right. But I want to talk a little bit more about the IPO landscape. I was having a conversation at the end of last week about how there's a structural change in markets, that the temptation to IPO just isn't as strong right now because you can get all your funding in the private markets. You don't have to be under the scrutiny of, the reporting schedule 4 times a year, analyst calls, et cetera. I want to hear your thoughts. Do you think that this is structural, or is this really just a function of market volatility?
So I have a lot of thoughts on this, Katie. So I would actually say if you break the technology comes into 3 categories, the very best ones are choosing not to go public. Now they may go public someday, but if you look at SpaceX or Stripe, Databricks and others, they have access to all the things they need to take care of their employees and their shareholders and get the capital to be able to do all the things they need to do, right? Then there's a category of very good companies, but there aren't these sort of completely epic power law businesses. Those will access the public markets. And then I think the way the software industry is commoditized, there's so many companies that need to find a way to be thriving in the private markets for the long term, because they're not venture darlings, and they're not the ones that IPO is going to be available to, because they're just not big enough. So I do think it's sort of segmenting in terms of what's the opportunity for different companies.
Speaking of companies that have remained private, you have been a big part of this artificial intelligence boom. I think back to March, which feels like years ago at this point, and you were part of, for example, one of the larger rounds we've seen of late, the mega round that made Anthropic almost $62 billion. You think about those valuations, even for these very highly popular parts of the AI market, do they hold?
Yeah, so I think there are 2 things happening at the same time. One is the technology brings the cost curve down on what it's going to take to access cloud computing and AI computing together. But the other is that because ChatGPT hit the zeitgeist, and every company, every CEO in every boardroom is now, what do we do with AI? The adoption is really fast. So what happens is, as an outsider, you look at these valuations and say, wow, how can a company create that much value? But if you look at their revenue bases, you look at their margin structures and their trend lines, you would say, these are not more forward priced than other companies in our traditional venture capital ecosystem. So, yeah, I think a couple of these companies are going to be massive, and they're going to defy gravity in the way they get there.
So how do you pick winners, though? And I know that what you do is much more sophisticated than that. But when you're deciding
It may not be, but yeah.
When you're deciding to get behind a company, what does your due diligence process look like? Because you listen to some of these AI pitches, and it sounds like magic. How do you actually thoughtfully try to determine who is going to do well versus who is maybe selling snake oil?
So look, I think our true north always, first and foremost, starts with the founders, the founding teams themselves. What are they doing and why are they doing it? There's a lot of authenticity in companies that go the distance. We do think a lot about when somebody says they're an AI company, what does that really mean, right? When ChatGPT happened, everybody started describing themselves as an AI company. It's like when mobile happened, when iPhone happened, everybody's a mobile company. And so are they really building with the modern tool sets? Is sort of another important dimension. And then the third is just understanding the theory of change, of how's work fundamentally going to change, and what is the role of these technology companies as they become providers of work versus workflows, and is that durable? So I think those are the kinds of things we'll think about, but I'll tell you, it's peak ambiguity. We really don't know how these markets are going to end up, but some of these companies are stunning the way they're getting built right now.
I'm going to kind of harp on that peak ambiguity point for a moment here. I want to show you what NVIDIA is doing right now. It's down more than 5% today. It's been down getting closer to 30% on the year. I know that you have more of a luxury of being in the private markets, although private markets are not immune to what's happening in the public markets. What you're seeing here is fears around the tariff uncertainty. You're seeing fears around the relationship between the US and China. What's that ripple effect look like across the AI industry when you see NVIDIA, which was previously that magical story that Katie was talking about, looking like that?
Yeah, look, I think long term, we think the AI opportunity is massive. I think we would all agree with that. I think short term, it does create this volatility, and it creates volatility at certain layers more than others. I mean, NVIDIA is practically a monopoly, and it's some of its largest customers developing chips, and it's got these sort of dynamics around tariffs. So I think there's a lot of pressures that create volatility around it. But I think broadly, when I look at the AI opportunity, it's long term, it's very strong. And in the short term, what I'm seeing is it is changing how businesses will get developed. And we have this whole thesis around global resilience, where the key idea is critical industries, health, defense, energy, industrials, things like that. Every country and every region wants to build resiliency around them. So that is re-globalizing the supply chains. That is re-globalizing how these businesses will take care of their local markets first. So that dynamic changes how you think about building companies in the short term. But long term, we always advise our founders to be values oriented and think about building companies that can be global in the end.
So short-term, some rethinking going on. Long-term, AI is still a massive opportunity. That's a good place to leave it. Great to see you in person. That is General Catalyst CEO Hemant Taneja. Meanwhile, let's get a check on these public markets because it doesn't look too pretty out there. The S&P 500 now down below 2% on the day, close to session lows right now on the S&P 500. You can see that sell-off easing a little bit in the bond market. That's a dynamic to keep an eye on, though you do still have two-year Treasury yields higher by about 2 basis points and a bid coming into the short end. I can't say the same for the dollar, still lower on the Bloomberg Dollar Index, and that money continuing to go into gold, now up 3%. We'll walk you through the sector breakdown next. This is Open Interest. All right, welcome back to Open Interest. Let's get a breakdown of this market right now. I think that the breadth is pretty stunning at this point. You take a look at the S&P 500, you only have 36 names in the green right now. That means that close to 500 names in the S&P 500 are in the red. The sole companies that are doing well, you have Fidelity up there as well. Ulta, this is sorted by percent change. I would actually take a look at the points, but it's a similar picture if you take a look at the losses right now because you have Nvidia, Apple, Amazon, Microsoft, Tesla, the list goes on. It's big tech that's weighing on this market. It's the same story if you take a look at the sector breakdown right now. But I do want to note that all 11 sectors are in the red, from consumer staples to consumer discretionary. Consumer discretionary is leading losses, down about 3% on the sector level, though a lot of that is Tesla. Now, coming up, we'll take a look at what the impact the global trade war could have on the world of AI. We'll discuss with the CEO of Oumi up next.
Now, AI platform Oumi says tariffs could have an impact on AI innovation. The key is open source versus closed source, they say. It says that open source platforms like itself are best to safeguard against trade restrictions. Joining us now, Manos Koukoumidis, Oumi CEO. The platform launched just 8 weeks ago by a team of ex-Google and Apple engineers. What a time to launch an AI platform. How are you navigating through this tremendous amount of uncertainty just really weeks into this venture?
That's exactly right. Quite a time to be building AI. But I would say quite a time to be building AI exactly the way we're building it in open source. Because as you were discussing, because of tariffs and anything else that's happening right now, it's very concerning about the leadership of the US in AI. Tariffs can have a very dramatic impact to the growth of these technologies as developed by the US. But if done right, if done in open source, then open source can create an open, unconstrained environment. In a world locked down by tariffs, open source can provide an unconstrained environment for the growth of these technologies. And I think it's extremely important, especially we want to maintain our leadership in the US, that especially in this time of trade restrictions, that we double down in open source approaches that are completely immune to the impact of tariffs.
Well, with that in mind, give us a little bit more flavor on what Oumi actually does. What does your platform do? What function does it serve? And who is using it, Manos?
Yeah, so the one way to think about it is think about OpenAI. So Oumi is completely the polar opposite. OpenAI, unlike what the name denotes, it's nothing but closed. In contrast, Oumi is a fully open source platform, fully open source AI. And the reason was that, and I developed this in collaboration with academics from many universities, over 13 of them, from Stanford, MIT, Berkeley, NYU, Princeton, and many more. And the reason why we built Oumi, even ahead of tariffs, and again, one more reason why we needed an approach like Oumi, was that it was becoming increasingly clear, and we keep hearing this now louder and louder from many large enterprises we talk to, that they can advance, they can build their technologies on top of a black box, closed source AI, what they're getting from the OpenAIs, the Anthropics, and everybody else. They need to have more flexibility and control.
Clearly, this open source model debate has made its way into the thinking of OpenAI executives, and all of their rivals. Meta, of course, has been advocating for this model. Ultimately, you think about OpenAI and the popularity that it's gained, the steam that it's gained. What do you make as a new company in this sphere about how dominant that they've been?
They've been definitely very dominant, but I think things will be changing quite fast. This may have been what I'm going to discuss way less intuitive and perhaps highly contrarian a year ago, definitely 2 years ago, but even a year ago. But what's become increasingly clear in the last few months, or especially weeks, DeepSeek was a good also wake-up call. And also, as we keep hearing from many large enterprises, they're increasingly saying, what, we experiment with something like OpenAI. It was easy, but now as we're getting more mature with these technologies, we need more flexibility, more control. We need to move to more open technologies. So I'm excited to see a big wave of large and smaller enterprises moving to open technologies. I would expect this dominance of OpenAI to decrease, both because enterprises need more open technologies, and because all the other open technologies are very quickly catching up.
And I want to talk about some of the products that you have out on the market. I know that Halloumi is your first tool that you've launched, and it sounds delicious, but what is the goal there? What problem does it actually solve?
Yeah, definitely sounds delicious. So it's also a very critical problem, arguably one of the most critical problems that enterprises have right now. Because what we kept hearing, for quite some time now is that for them, especially for many regulated industries and beyond, where they want to apply AI in mission-critical scenarios, the biggest obstacle for them to scale up their use of these AI technologies is that they can't trust them. They say, if we don't know when AI is lying to us, how can we put it in production? How can we automate different processors, use it to help us make decisions? And what Halloumi does, you could think about it as the AI lie detector, or to be more precise, AI claim verification. This means that anything that an AI model claims to you, anything that it outputs, it fact-checks it one by one to make sure it's grounded, it's factual, based on the document. For example, using a big document you're summarizing, or asking to answer a question based on, again, a large document, can make sure that every single part of the response that you got from this AI model, it's grounded on the information that you have.
Our thanks to Manos Koukoumidis of Oumi. Katie, we're going to get to check on these markets now because our decline resumes.
Yeah, it's ugly out there. The S&P 500 pretty much at session lows right now, down about 2%. I will note that volume is pretty low relative to the last 20 days, about 30% below its 20-day average, though we do have plenty of catalysts that could change that narrative. And then I just want to keep up the 10-year Treasury yield. We're just about flat. We were higher to the tune of 6-7 basis points earlier this morning, but yields coming in. Can't say the same for the dollar, still down about 0.8%, and that gold bid continues. But let's take a look under these public equity markets right now and take a look at what's moving underneath the hood with Bloomberg's Isabel Lee.
Hey, Katie. So we're looking at Hertz. It's down by more than 10%, but I want to bring up that it gained 55% on Wednesday and 44% on Thursday. So we saw this huge swings when Bill Ackman's Pershing Square amassed a nearly 20% stake in the company, and they started building that out last year. So Ackman is betting that Hertz can get past its bad bet on Tesla EVs and also capitalize on the potential rise of auto prices, of course, when the President Trump's tariffs on auto imports will be imposed. It also relies on just the new leadership of Hertz, and Ackman sees a path for Hertz to get to $30 a share by 2029. It's trading around $7 now, so that's a big bet there.
I want to also talk about another big bet, right? MicroStrategy, now known as Strategy, obviously still volatile in the middle of this market.
Definitely volatile, but we have CTBC Securities initiating coverage on it, and they gave it a buy rating. So that's really interesting. I feel like with this stock, it's either you love it or you hate it, and they do love it. They set a price target of of $420. That implies around a 30% upside. So we know that MicroStrategy began hoarding Bitcoin in 2020 to really hedge against inflation. Questionable whether that worked or not, but they're really aggressive because last week they bought around 6,000 Bitcoins, bringing their total holding to around $36 billion.
All right, someone has conviction in this market, and it's Michael Saylor. I do want to talk a little bit about Netflix here, because Netflix, it was higher by about 5% or so earlier this morning, but some of that enthusiasm is fading.
It has faded, but this is a company that also had big bets. Remember last week they said that they're aiming for that $1 trillion market cap. It's around $400 now, so that's more than double. But they had a record profit to start the year. They really just allayed any concerns that they will be impacted by this tariff-driven sell-off or any uncertainty that may bring. First quarter earnings rose 25%. Sales were in line with projections, and investors have really just come to see Netflix as a safe place. Someone told me that it's not discretionary anymore, but a necessity.
It's a
I don't know if
staple.
you share that view, but I just binge watch all the time.
Necessity for me, at least. Bloomberg's Isabel Lee. Lee, thank you so much. Now, Katie, I want to bring you back to that move in the 10-year, because we were flirting with 4.4% just a little bit earlier this morning, and we have come almost full circle, as you said, pretty much flat on the day. Now, the moves had started lower in terms of yields before that Trump Truth Social post, but certainly accelerated since then. That was a little before 9:45 this morning. Now, my question is, if you think about Trump negotiating on trade, my question becomes, is Trump negotiating with Powell on interest rates? This has clearly become a move here to get him to lower rates in the face of what has been inflation above the Fed's target.
I really think on so many levels, Trump is just negotiating with the bond market. When it comes to trade policy, when it also comes to potentially removing Powell, it's going to be interesting to see how the bond market reaction develops, if yields scream higher on the long end again. But I'm excited to discuss all of this with Claudia Sahm. She is coming up next to talk about all the ways that Donald Trump is searching to fire Jerome Powell. She joins us next. This is Open Interest.
The fact is, the inflation rate is higher, growth is slower, the job market is worse. So we really, I strongly hope that we do not move ourselves into an environment where monetary independence is questioned.
If you think that it's unacceptable for President Trump to be frustrated with the policy history of the Fed, then I think that you got some explaining to do.
That was National Economic Council Director Kevin Hassett and Austin Goolsbee of the Chicago Fed. President Trump is ramping up criticism of Fed Chair Jerome Powell. So let's discuss now with Claudia Sahm. She is New Century Advisors chief economist and former Fed economist. Claudia, great to have you with us. There was a note from Winthin over at BBH this morning saying that the admission that this is being studied at all should be taken very seriously and very negatively. And Claudia, I'm curious, how seriously are you taking the possibility that we do see Trump try to remove Jerome Powell?
I take it very seriously. And this administration has taken steps, whether it's with the tariffs or with downsizing the government, that really were, beyond expectations. So the unthinkable is thinkable with this administration. So it is a risk to take seriously. But I do think when the administration sits down and studies the options, they'll come to the right conclusion that this really isn't the path they want to go down.
Now, I also want to talk about the precedent here, because people often point to what had happened in the Kennedy era, in the Johnson era, in the Nixon era. People often point to Nixon, Burns. The difference now is the amount of tools in the toolkit, I think, that the Fed has brought out in terms of quantitative easing, emergency measures during crises. The power of the Fed has grown. So what does this mean to have this kind of political pressure on the Fed in an era where the economy is so fragile?
Right. So the Fed needs to be independent, but the Fed absolutely must be accountable. And it is. Congress created the Fed. It has amended the Federal Reserve Act over time. The Fed has to report to the public, report to Congress. And, there are times where Fed has used tools, such as in the great financial crisis, they did emergency lending. And then after the fact, Congress said they amended the Federal Reserve Act with the Dodd-Frank and said, to do that, you're going to need Treasury's buy-in. And that happened during COVID. So there are times where we watch the powers of the Fed, and Congress, put some controls on them, but that operational independence, that ability to set interest rates with monetary policy, not just in the US, but around the world, has become to be understood as very important to keeping inflation low. And we're seeing it. This is the moment why we need Fed independence, where you have strong views kind of clashing between the president and the Fed. It's not personal. It's just the experience is we need the Fed to be able to make the decisions that they think are best. And we can hold them accountable for that after the fact, but they need to be able to make those decisions.
It's a good reminder, too, that we all have bosses, including the Fed. In Jerome Powell's case, it's Congress. But I want to go back to what you were saying in your first answer, that you think that they're going to study the options, the administration that is, and that they'll arrive at the conclusion and won't go through with this. And I'm curious, what gives you the confidence? When they look at the options, what do you think that they'll see?
It's in the absolute best interest of the president, with his economic agenda that he has set, to give the Fed its space to make its policy decisions. One of the things that, the Fed they're uncertain about what happens with inflation, particularly if it becomes embedded. So they are really trying to, we're the inflation fighter. We're going to be credible on this. We've seen market expectations. They expect the tariffs maybe to lift inflation this year, but then come back down. That is exactly, that is the path that the president would want to see, with the tariffs, not to have it be long-term inflation. So let the Fed do their job. If the president undercuts this Fed, it will not just undercut, remove Jay Powell, it undercuts any future Fed chairs that Trump would put in place. And it really could cause a lot of disruptions. And if he removes Powell, he's not going to get interest rates down anyways. They're going to go, because the inflation expectations would go berserk. So I absolutely understand why the president is critical of the Fed's stance right now, but this isn't the way to interact with the Fed.
Well, Claudia, you touched on something that Shana and I were discussing earlier, that you think about Kevin Warsh, who has been reported as in consideration. Other outlets have reported that he, too, has urged the president not to necessarily end Jerome Powell's term early, exactly for that reason, that if he was then made Fed chair, that he would be dealing with a loss of credibility at the institution itself.
Right, and we have to look back. The credibility that the Fed gained in terms of being inflation fighting, much of that was won during the Paul Volcker Fed, and that was a very severe recession, very high interest rates to break the inflation mentality. We do not want to go back. No one wants to go back there. So the Fed is an institution. It plays an important role. It doesn't always get it right. The president could be right, and there is a case for preemptive interest rate cuts. It's just that's not a case that he should be making, and certainly removing or even threatening to remove the Fed chair. That's creating more uncertainty in a world right now that, frankly, is dealing with a lot of uncertainty in terms of the economy and financial markets. So this would be a great time to de-escalate this.
Well, Claudia, I want to bring up something that was brought up from Neil Dutta of Renaissance Macro this morning. This is exactly what he wrote, that forget the legal obstacles to fire Powell. Getting rid of him in such a dramatic fashion would upset the bond market. Risk premiums would rise sharply as investors question the central bank's independence, and longer-run interest rates would surge. That was from RenMac this morning. But then you also have this morning, we were talking about it a little bit, Katie and I were talking about it. You have the president this morning not saying he wanted to fire the Fed chair. He said that he wanted him to lower interest rates. You saw on the heels of that just the 10-year lose some of its sell-off. Do you think this is turning into a negotiation tactic more than a reality?
It's really hard. It's hard to judge, right? I don't know where the president is going from this. It's great to see this morning's message on True Social did not include a threat of termination. It is also problematic to be having this, if you call it a negotiation, in public, right? Because now it does. So suppose the Fed meets and they cut interest rates. Did they do it because the president told them to? Right, this is not a healthy discussion to be having. I understand, and again, the president and many presidents, Trump is nowhere near unique in this, don't like what the Fed does, right? That's part of why we need the independence of the Fed, is just having this debate in public and putting this pressure on. It's one of those, be careful what you wish for, right? If the Fed caves, it would be really bad. I don't expect the Fed to cave on this, but it would be really bad. And it makes a very complicated policy decisions for the Fed this year, even harder if they have it with all of this political tension and these conversations going on.
To that end, also, how do you see the reaction from the bond market, not just in the short term, but in longer term rates? You think about the 10-year yield flirting with 4.4% this morning, now closer to 4.34%. Is there a risk that a deep recession would drive down those longer-term bond yields significantly, or that fiscal pressures of the United States will supersede all of that, and you actually see those longer-term rates go higher?
Yeah, so everything is on the table. That's part of the problem right now. And there really is a lot of uncertainty. We're doing major policy changes from trade to fiscal to immigration. And then if you want to put, Fed independence on the table too, it's just a lot for anybody who's trying to look out into the future, which is exactly what financial markets are trying to do. They're trying to look out into the future and price it. And honestly, I think that one thing that we should be very comfortable with is we're going to see a lot of volatility. We're going to see a lot of shifting narratives until that uncertainty is pulled out. And the president, again, has a very unique position in that he can pull some of that uncertainty out right now.
Yeah, definitely. I mean, a lot of this uncertainty came from his desk itself, and obviously, like you say, he has the levers to pull to remove that uncertainty. But I want to talk about the numbers that the Fed has in front of them. Politics aside, when Jerome Powell and his colleagues are sitting down to make policy, they have, of course, inflation, they have what the labor market is doing, and they have, of course, what we're seeing in terms of break-even inflation expectations and the like. President Trump, in his Truth Social post this morning, said that you have energy costs way down, you have food costs way down, you also have most other things trending down, and as such, he concludes, there's virtually no inflation. What are you seeing, though, Claudia? What is the actual read on inflation right now when you take a look at this data?
Well, our broad-based measures of inflation, so not just picking out particular series like energy, they show that inflation continues to be elevated relative to the Fed's 2% target. And it's been that way for, since 2021. We've been making progress. And honestly, the conversation we would be having right now is about the upcoming Fed rate cut because of progress on inflation and the good economy, if it were not for some very big changes that have been made in economic policy going forward, above all else, the tariffs, which just aren't in the data yet. Right. And the Fed has to think about it. I mean, the markets are thinking about it. Everybody's thinking about what's coming ahead. So, yes, it is good that we've made progress on inflation. That is amazing, where the labor market is great. But that does not tell us necessarily where we are going over the coming months. And the Fed, with all this uncertainty about the policy, their wait and see approach to this, I think, makes a lot of sense. And so they're going to they need to see the data. And above all else, they need to see that the inflation stays under control.
Claudia, we got to leave it there. We thank you so much for your time this morning. Claudia Sahm of New Century Advisors. Now, coming up, Salim Ramji. He's still optimistic about U.S. exceptionalism. Part of Katie's interview with the Vanguard CEO next. This is Bloomberg Open Interest.
Well, the Sell America trade is gaining momentum today, with President Trump's threats towards Fed Chair Jerome Powell adding doubts to the U.S. haven status. Last week, I sat down with Vanguard CEO Salim Ramji and asked him if he thought U.S. exceptionalism has peaked.
Clients always need to be balanced, and we've been saying that for decades, in terms of the right mix between U.S., international, the right mix between stocks and bonds. So we're always advising clients to run a balanced portfolio if it's aligned to kind of their financial goals. But when you just look at the underlying innovation kind of in the economy, and you look at the underlying kind of growth over decades across the United States, it's we're certainly seeing it in our flows, but we're seeing it in our clients' behaviors and in our own team's investment beliefs.
Of course, that was Salim Ramji, Vanguard CEO, talking to Katie Greifeld in what I believe was an exclusive interview that you can catch more of as well. In the meantime, let's check on these markets, Katie, because it's been a brutal sell-off this morning.
Yeah, absolutely. Salim Ramji saying U.S. exceptionalism hasn't peaked, but at least in these markets, a snapshot over the past few weeks, you could make the case that perhaps it has. That's the story today as well, with the S&P 500 down over 2%. You do see bonds coming back in from that sell-off, but still higher by about 3 basis points or so on the 10-year Treasury yield. The dollar in the gutter, and gold really getting that haven bid. We'll continue to keep an eye on that and discuss tomorrow with Citi strategist Stuart Kaiser, as well as Goldman Sachs chief economist Jan Hatzius. This is Open Interest.